All right.
Yeah,
Let's see here. I think we're starting to let people in,
started
Jason.
here, coming in. Give them a couple more seconds. All right, we'll probably get started here.
All right. Well, good morning, everyone. I know we still have folks coming in, but I know we have a lot to cover as we usually do. So want to be mindful of that. So we're going to go ahead and get started. Welcome to AllGen's quarterly update and market review. Today's January 22nd of 2026, and a lot going on. I don't know, obviously it's a new year, and it's a lot happening economically, politically, all that kind of fun stuff. So we're going to touch upon it today. But for those of you who've been here in the past and who are attending this live, we want to just remind you of the format for today's webinar. It is live, but it's being recorded. Okay, so right now when you're attending live, it's in listen-only format for the attendees. However, you can ask questions at the bottom. The raise hand is scratched out, but if you go into the Q&A box, you can ask questions, and we encourage you to do that during the presentation. We will leave the questions till the end, so as to not interrupt Jason's flow. But we will always attempt to address all the questions that are asked. So please feel free during the webinar, if something we say or something that you just have on your mind, even if we didn't say it, comes to mind, please feel free to type it in, and we will hopefully address that by the end of this presentation. As you guys, if you've been here before, you know this. If not, welcome to the webinar. We like to start off a little bit with a little bit of engagement. So we always start up with a poll question so you can actually interact and we can get the blood flowing and the attention going. So I'm going to request that we go ahead and show the first one. And we're going to start with a fun one. So it's Super Bowl season. Every year we got to ask this question. What excites you most about the Super Bowl? The commercials, the Super Bowl party that you'll be attending, halftime show, a good close game, or you just don't really care. It's not that important to you. So if you could take a second there and answer the question, I'll give you, the what is it, the Jeopardy time do 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 song for you to go ahead and click and answer. Okay. And that being said, let's go ahead and see who said what. And survey says a good close game. Okay, came in first. Okay, with second commercials, and then we got one person that's very intrigued about the halftime show this year. Okay, so very good. So now we're gonna get a little bit more serious in terms of opinions on the economy, and the question will pop up here shortly. Okay, which of the following do you think will have the biggest impact on the markets, investment markets this year? So shifts in Venezuela's leadership and political direction, geopolitical tension around Greenland and Arctic strategy, U.S. immigration policy actions and ICE coverage, or ongoing debates over healthcare coverage and costs. Okay, stuff that we've all been hearing in the news lately. So curious, which one of these do you think will have the biggest impact on the markets this year? So again, we'll give you a few seconds to make your choice or your selection. Okay, and with that being said, survey says it's a close one. We've got Greenland and we've got healthcare coverage coming in first. So interesting. And again, I know Jason's going to touch upon this in today's presentation. We appreciate your feedback. Again, just want to remind you, for those of you who joined us late, if you have any questions that you had going into this webinar or arise as of something we said, you think of anything, just please feel free to type it in the Q&A box at the bottom. And while we'll leave it for the end of the presentation, we promise we'll try to get to every question that's asked. Okay. So that being said, I'm going to go ahead and turn it over to my business partner, Jason. Tell us what's going on.
All right, thank you. Well, welcome everyone. Excited to share some cool stuff with you guys and a lot of things going on. The year started off with a bang in terms of news coverage for sure, and what's been going on with the economy and all types of geopolitical stuff. So, but before we get started into that, let's look back over the last 12 months and just kind of look what did the best in 2025. And probably not too surprising to some, gold was up 64%. So gold had an incredible 2025. What may be a surprise to some people, though, is that international markets actually did 30%. The MSCI All Country World Index, ex-US, did 30%, which did significantly better than the S&P 500, but not too many people would be too bad with taking an 18% gain for a year. That's a pretty good gain. And then you had the small caps from a stock perspective underperformed, however, still did an 8% return. And for the first time in a long time, bonds actually had a really good return for bonds. That is, they returned 7%. So it was a year where pretty much everything went up. All of those years are great years. Everyone likes to be a part of them. However, if you guys recall, back in April of 2025, you kind of had that tariff scare. We actually did have a couple calls. We have some really good clients with a good long-term mindset. So most people don't get shaken out of the markets with that type of news or scare, but did have a couple of people asking, hey, should we get out of the market? And I'm glad no one really actually pulled the trigger and got out of the market, because the market did extremely well after that. And that's something just to keep in mind. We're always going to have throughout history lots of different scares, whether it be an economic scare, whether it be a pandemic. And while those things are important to monitor, we should always have a long-term mindset. And historically, over time, markets have always come back, some faster than others, and that was the case for last year. So here's another perspective to look at it, just from kind of the low in 2022 after the last bear market. The S&P 500 is up 95%. And so now this is not a logarithmic chart. So these moves look a little bit bigger, meaning these aren't based off of percentages, but a nominal 1,000 for the S&P 500 index. If you saw it from a logarithmic standpoint, it may not seem as extended. However, that being said, a lot of people are concerned that the market has gotten too high, that valuations have gotten too high, and then at some point it has to come back and drop and go down. And while I'm not saying that isn't the case, sometimes it will have to drop, and markets, that's the way they work, right? They go up and then they come back down at some point. And if we look at a forward PE ratio, we're at a pretty high point, 22.3. If we look at the peak of the markets and the other times, where this is a peak right here, this is a peak right here, and that's a peak right there, you can see where the forward PE was during those times. And it's higher than all of them except for 2000. In 2000, we got up to 25.2. From a dividend yield, a higher dividend yield would show the market is at a better value. A lower dividend yield would show that the market is overvalued. And that, from that standpoint, we are also at kind of the below or showing overvalued compared to historical highs, or even right there with the 2000 high. And then from a 10-year Treasury standpoint, we're at 4.2%. So not, or definitely much higher than the highs in 2020 and 2022, but not quite where we were in 2000, 2007. So let's look a little bit closer at the valuations of the market. And so this chart, what we're looking at is the S&P 500, and it's looking at the forward PE ratio. PE meaning price divided by earnings, and the forward meaning is looking at the earnings projected over the next 12 months and what the price is now compared to that. It is historically been a decent valuation metric to kind of see if the market is expensive or cheap. And you can see kind of from a standard deviation or a 30-year average, this middle line would be the average at 17.1. And however, if you were considered expensive, it would be over this one standard deviation. And right now, the markets are considered expensive from this valuation metric. The S&P 500 is, and as we're at 22.3, which is right there, just slightly above the high in 2020, but not quite at the high that we were in the late 90s, early 2000s. That being said, when we look at the S&P 500, it's basically looking at the valuation of large cap stocks. And so this is another way to look at valuations, not just looking at large cap stocks, but also looking at other areas of the market. So what this little chart here on the right is telling us is you take the 20-year average of the forward PE ratio, And then if we were currently at the 20-year average, the number would say 100%. That means we're at the average. If it's at 145%, like large cap growth, that would mean that we're at 145% the 20-year average. And that would show that the market is expensive. And so if we look here, where is the market most expensive? It is that large cap growth area. The AI driven, the tech stocks, the NVIDIAs of the world, those have gotten pretty expensive, the Mag 7. And that sector in general has gotten the most expensive out of the market. However, if you look at some other areas of the market, while it is still slightly above 20-year averages, it is not nearly as extended as a large cap growth. So mid cap, mid cap value, mid cap blend, small cap, pretty much all the way across. While it is slightly more than the 20-year history, it is not, or 20-year average, it's not super high, especially compared to large cap growth. So this is a chart to kind of look from the perspective of how is the S&P 500 doing, okay, compared to the S&P 600. So S&P 500 is large cap stocks. S&P 600 is small cap stocks. So it's a ratio between the two. If the line is going down, like it was for nearly a 20-year period from 99 to kind of 2019, that would mean that small cap is outperforming. If the line is going up, that means large cap is outperforming. So really since about 2018, all the way until now, you can see that large cap has been outperforming. However, while this is not the only indicator that we use to determine if we should shift between different areas of the market, it is one of them. And so from a technical perspective, you can see this line has just recently broken its upward trend line, and the shorter term moving average is about to cross the longer term moving average. And while that does not tell you for sure that one sector would be outperforming another, it is one clue to say there is the potential that small cap may start to go back into a time frame where it outperforms large cap. And so that is something that we're monitoring pretty closely. And while the technicals are a piece of what we look at, as I showed you in the last slide, valuations is another area that we look at. So small cap, mid cap area, which we sometimes reference as mid cap, that area is cheaper than large caps, and especially large cap growth. So that's an area that we have been very underweight in. It is like we showed you in one of the first charts. It was one of the it was one of the lagging markets out there. It only performed 8% versus the S&P doing 18. That may start to change. So that's something that we're watching to see if we need to shift a little bit more small cap, and we're looking into making that move after being underweight that area for a while. Now, I point out this chart. These dates here at the bottom are a little bit small, and so I'll read them to you. This is 1992, and the end of the chart is 2000. And so if you're as old as I am or older than me, remember in the 90s, you had a big run in the stock market, and that was kind of the whole dot-com technology boom, and markets did really well during that time. And you had a lot of people say that, hey, the market's starting to get very expensive. The market it's got to crash, it's got to come down, and it just kept going. So I point this out that even some of the smartest people in the world, like the Fed chairman was back there, Alan Greenspan was the Fed chairman at the time. In 1996, it was actually December of 1996, he used the term irrational exuberance, meaning the market is going up at an irrationally kind of giddy or exciting way. But the reason he said that is to warn people that valuations are very expensive and the market could go down because the markets do tend to get risky when they become expensive. That being said, the market went up for another almost 3.5 years, and it went up another 107%. I point that out just to say that, we've had some concerns, and we are also concerned that the market is a little bit expensive, and there's certain pockets of the market that are very expensive. But just because things are expensive, and even if we're in a bubble right now, bubbles a lot of times can get a lot bigger than what you think they can get. So we always caution people of just selling because things are expensive. We'd like to see a combination of things getting expensive, that from a technical standpoint, the market's starting to take a dip. From an economic standpoint, the economy starting to go down. So we want to use a weight of evidence approach and look at a lot of different factors to say, hey, should we dial back stocks because of multiple factors, not just valuations, but a lot of other areas too. We added this cool little chart here on the right, and what this is it basically looks at the forward PE, where the forward PE is right now, and then historically when the forward PE has been at this valuation, what has the next 5 years done in the market? And so you can see if you down here at the bottom is the PE ratio, and the further you go to the left, it means the cheaper the market is. The further you go to the right, the more expensive the market is. This red line is where we're at right now. These other gray dots are all the other different time frames in the past. And as you can see, if when markets are cheaper, these gray dots and this regression line right here will show you that typically when markets are cheaper, the next 5 years is going to be a better performing market. And typically, you can see when you get in a very extreme scenario where we're not quite at just yet. But when you get very a very expensive market, like if you go to the right of or a little bit more expensive than where we're at right now, all of these gray dots show that over the next 5 years, these are the returns, this left axis, over the next 5 years, every single time the market's been negative. We're not there right now, so I'm not trying to scare you. We're at a point where over time, yes, over the next 5 years, when markets get this expensive, and I'm specifically talking about the S&P 500, then on average, the markets have had lower returns. But I wanted to bring this chart out to show you that look at these five-year time frames right here, these 5 gray dots. When the market's been this expensive in the past, there were 5 times that the next 5 years had returns over 15%. Some of those are 17 and 18% annualized returns over the next 5 years. So I just point that out to say, just because markets seem expensive does not mean that they can continue to run and go higher. And so that's something that we have to keep in mind. And we're not just going to go off of a gut feeling to make an adjustment to our accounts or to go overly conservative, but we're going to use a weight of evidence approach to see if it's time to shift out of some stocks or go more defensive. Now, on a positive note, the economy seems to be strengthening. So what's typically most important, and one of the most important things about kind of gauging the strength of the stock market, is earnings growth. Okay, so basically profits, right? And if you look, last year we had about 11% earnings growth. The next 2 years are predicted to be a 15% growth for 2 years in a row. And on average, if you look kind of over the last 10 or so years, that would be a pretty strong growth time period for the market. So while prices are expensive, and especially you're comparing price to earnings, as long as earnings continue to grow at a good rate, you can have prices continue to grow and not increase that ratio. So if you do have a strong earnings period, that can still allow the market to run higher. So that's an encouraging sign. And those are estimates, and you never know what's going to happen, but that is an encouraging sign. Now, the other thing, and this is something that we pointed out in the last webinar, but margins are very high. And one of the kind of the benefits of the whole AI move, if you will, and how that's helping companies is helping companies to be significantly more productive, and it's helping companies to have higher profit margins. So you can see we're pretty close to an all-time high in margins. When margins are strong, that's typically good for the stock market. You can see when margins start to drop significantly, like it did right here, that was 2008, that's bad for the stock market. You can see when the market took a hit right here too, that was bad for the market. But then you can see also when it goes up, that was a very strong period in the market, 2009 all the way to kind of 2020 timeframe. But if you can see right now, we're pretty close to an all-time high and trending in the right direction. So something we'll monitor over time, but that is also something that continue to help markets drive higher. Now, one thing we also keep a very close eye on is sentiment. And so there's a great sentiment indicator called the daily trading sentiment composite that Ned Davis Research, that's what NDR is, puts out. And it's basically a culmination of 20 different sentiment indicators. And sentiment basically means how is the market feeling, basically the general population feeling about the market. And the theory goes, and it's been a very accurate one in the past, is that when people are extremely complacent, meaning they're excessively optimistic, then markets typically don't do well. The reasoning behind that, I know that sounds counterintuitive. The reasoning behind that is if you were very excited about the stock market and you thought it was going to go up a lot more, then you've probably invested all your cash. Okay. And that means cash being demand, if you think about it from going back to economics, and then supply being the number of people who own shares of stock. So if you're fully invested in the market, a lot of supply of shares of stock that are out there that could be potentially sold, and not as much cash, so lower amount of demand. And so we're in that position right now where people are, or the general population is excessively optimistic about the stock market. And when that time frame has been, when we've been at the level that's kind of above this dashed line right here, markets have had a negative 1% return over the last about 20 years, a negative 5% return since 1994. Doesn't mean we should go and sell everything, because there's certainly times that markets can continue to go up even when you're in a very optimistic or excessively optimistic time frame. But it is something that we want to watch, because when markets get overly optimistic, that can sometimes lead to poorer returns in the market. And again, this is the S&P 500, which is large U.S. companies. All right, so for what's been very popular over the last 5 years or so is the Mag 7. So the Magnificent Seven, as you guys know, it's the Apples, the Amazons, the Googles, the Metas, the Microsoft, Nvidia, Tesla. That's the Mag 7. And for a period of time, as you can see, the green line right here has significantly outperformed the S&P 500. And then if you look at the remaining 493 stocks of the S&P 500, taking out the Mag 7, that didn't do as well as even the S&P 500 as a whole. So, but there's been a shift. If you look at 2023, every single one of these Mag 7 stocks significantly outperformed. You see Nvidia with the 230% return, Meta with almost a 200% return, and all of them had significantly higher returns than what the S&P 500 did. In 2024, you can see the Mag 7 started to do still really good, but not quite as good as how it did in 2023. Look at 2025. Only two stocks of the Mag 7 actually outperformed the overall S&P 500. So it's been shifting now in saying that, okay, hey, that's the large cap growth area that may have run its course. We need to think about being more diversified than just holding those Mag 7 stocks. And I'm not saying that all of those stocks are going to go down, but a lot of times when you have those massive runs, even if they're still really good companies, they may have become too expensive and may need to consolidate for a period of time, may underperform. And that seems to be, at least that's what happened in 2025, but that also seems to be kind of the trend as we go forward into 2026. So shifting gears a little bit, but going to kind of what we see as kind of the catalyst going forward for the market. And some people think that we're in an AI bubble. I would say that I don't think I think we have some more room to go. I'm not saying we're not in a bubble, but I think we have some more room to go with the effect that AI could have with the economy and improving the economy. And so what we're looking at here is what percentage of firms what's the percentage of firms' use of AI applications? And obviously, international information technology sector would be using it the most. Transportation and warehousing is using it the least right now. But between all of them, about 17%, they're reporting 17% of AI application within businesses. If you rewind for me back to the 90s and go back into kind of the mid to late 90s timeframe, I remember similar charts to this, but the question was what percent, or the statistic was what percentage of firms are using the internet, and that was a smaller percentage back then. However, everyone knows that right now 100% of companies are using the internet. I really feel it's going to end up being the same thing for AI too. We're going to get to the point where 100% of companies are using AI applications. And so that being said, if we're at 17%, I think we still have quite a ways to go before we, kind of reach capacity there, or reach the limit of, not the limit of what AI can do, but run out of the momentum that it can provide for the markets. All right. I point this out just because we've had some geopolitical things occur over the last few weeks that have caused some concern. Certainly last year with the whole tariffs, you had a little bit of the tariff thing with Greenland recently. That seems like that's kind of passed by. But when it happened last year, the market pulled back 19%. So basically, this is what the markets have done year over year, the gray line. But then at the worst point of the year, these are the red dots. So you can see the market did about 16% last year. But during that time in April, you had the markets drop all the way down where it was down 19%. So all that to say, we want to always reiterate, we're going to sound like a broken record, but it's super important to keep that long-term mindset. Be careful with those intra-year volatility hits where the market takes a big hit. Don't allow that to scare you out of the market. We're certainly in a time where there's a lot more geopolitical concerns that could drive some volatility. So keep a long-term mindset. Now, when we look at, it's kind of shifting here to the dollar. The dollar has kind of been pretty big into the news last year, as it did take quite a bit of a dip. You can see that was 2025. This is a long-term chart going back nearly 20 years. We are still in an upward trend in the dollar. However, it's been like 3 or 4 webinars in a row. We've been testing this trend line right here, have not quite broken that yet. However, if we do break this trend line, that could mean that the dollar is going to start a new kind of longer term downtrend. Not necessarily a bad thing. However, it is something that we need to monitor because certain asset classes do better in a falling dollar environment versus a rising dollar environment. And specifically, what tends to do better is international stocks. And so, as we pointed out at the beginning of the presentation, international stocks have done significantly better in 2025. They're also doing the best of all stock classes, or better than US markets in 2026 as well. So, if you look here, kind of 15-year average, like international stocks, excuse me, US stocks have just dominated international stocks over the last 15 years. US stocks have averaged a 14% return, whereas the Eurozone has done about 7.8, Japan 6.9, emerging markets 4.2, and China 4.1. So if you were diversified and owned both US stocks and international stocks were a drag on your portfolio for that 15-year period. And then you hear a lot of people talk and still say, you should just own the S&P 500, and you would have been 100% accurate over the last 15 years. That would have done significantly better than having diversified a portfolio with international. That being said, we go through this kind of pendulum where US stocks will outperform for a 10 or 15-year period, and then international stocks will outperform for a 10 or 15-year period. And I believe we're probably on the cusp of that happening. It certainly started in 2025. You can see the Eurozone doing 41%, emerging markets 34, China 31, Japan 25, all of them significantly better than what the S&P 500 did. And even to start the year in 2026, US markets up 1.8. You can see where all the rest of the international markets are doing better than US markets. There's there is kind of one catalyst that a lot of people thought was a driver to this, is the weakening dollar. And the weakening dollar by this chart would be the purple portion right here. So the currency, the euro getting stronger than the dollar, if you owned international stocks from US dollar, like if you're an American citizen owning international stocks, the benefit of the euro getting stronger than the dollar also added to your returns last year. But that wasn't the case, so much the case in EM and China and Japan. You can see the currency did not make that much of a difference. And what you can see in pretty much all of these cases is that multiple expansion, meaning companies' stock prices growing, were and just the ratios, like the price to earnings getting higher, were a part of it. Dividends, earnings in general, were bigger drivers. And so while the dollar getting weaker was one of the catalysts for international stocks outperforming last year, there is another catalyst in that those stocks performed well. Their earnings went up. dividends were much higher. And what we've been pointing out for a long time, they've just been at a significant discount to US stocks. In fact, over the last few years, they're at a 50-year record in terms of their discount compared to what they trade to US stocks. And so if you kind of have that Warren Buffett mindset, you try to find the stocks that are the cheapest from a valuation perspective. And that would have been a good area over the last couple of years. And that is still the case. Definitely their multiples have gotten higher, but they're still at a discount to US stocks. And just going off of memory, but I believe historically, we trade at about a 19% discount, or excuse me, international stocks trade at about a 19% discount to US stocks. Historically, that's kind of the average. And right now, they're still at about a 31% discount to international stocks. So we still think, even though the S&P 500 and also large cap growth specifically is very expensive, you have other areas of the market that aren't as expensive and still look somewhat attractive. Okay, so I point this out because this is kind of similar to that other chart where you're taking US stocks, and we're using the Vanguard Total Stock Market, symbol VTI, versus the Vanguard FTSE. A FTSE is kind of like the MSCI All Country World Index. It's an international index. And so this is kind of that point where over the last 15 years, you can see that so if this line's going up, that means US stocks are outperforming. If the line is going down, international stocks are outperforming. And you can just see over that 15-year period, US stocks have just absolutely dominated and consistently outperformed international markets. Well, take a look here. If you zoom in just kind of to 2025 and early 2026, you can see this line has broken its long-term trend line. The moving average has also crossed over, and that is signaling from a technical perspective that international stocks may start to shift where they outperform from a secular time frame. Secular, when you're talking about trend analysis, is longer term, like 10 or 15-year time frames. And so you can see that we are starting a downtrend. And when you compare US markets to international markets, that means international markets have been outperforming recently, and they could go into a time frame where they do outperform again. And to point out that time frame, so yes, the last 15 years, US stocks have significantly outperformed international stocks. Well, look at the 10 years prior to that. So 2000 to 2010, you can see the orange line being emerging markets, the purple line being international, and the blue line being the S&P 500. Over that 10-year period, the US stocks were actually down. The S&P was down 9% from that 10-year period. Emerging market stocks were up 157, and international stocks even significantly outperformed. At their peak, emerging markets were up to 237% right here. International markets were up 76%, and US markets were up 18%. So there are time frames in history, long time periods. And if you go back even further times than this, where you'll have these secular longer term trends where international will outperform the US. And I think there is a good chance that we're entering into that time period. I think we actually already entered into it in 2025. So one other thing that tends to outperform in a weakening dollar environment is gold. And so, looking at this is a long-term time frame of gold, and you can see that it also has secular trends. So from in the 70s, from 1970, kind of that 1981 time frame, it was up 11 years. It did 1,830%. Then went into a long downtrend from 1980 all the way to the early 2000s. Then you had another secular uptrend, 10 years up 638%. And then people are questioning right now with gold, and even people are pointing out silver, like how much longer can this run last? And yes, it has gone up a lot, and it's certainly had a lot more risk when it has gone up as much as it has to be able to pull back. But if we look at what gold did at these other two time frames, and I'm not saying we're going to do the same percentage return, over the last 8 years, gold has also been trending up. It's up 292%. It's up a lot. It's done really well. But there is the potential it could go higher. And it's not just because of a weaker dollar. That is one component of it, but it's kind of the perfect storm for the gold, at least over the last few years. You battled inflation for a while. You also had a lot of geopolitical concerns. So, anytime markets get concerned or wars are happening, a lot of geopolitical tension. Those are good time frames for gold. And the reason for that is this chart is going to show you, but it is a little complicated, so bear with me on this one. So this basically looks at foreign holdings of US Treasury bonds. That's the blue line. So you can see kind of in the late 90s, early 2000s, foreign countries were buying a lot of treasuries and they're holding a lot of treasuries. But then you can see the official gold reserves for all countries, how that was slowly going up, but you can see it really accelerated right here. And in the same time frame, you kind of had from 2012 on the level of how many treasuries that foreign countries are holding kind of leveled off. So the gray line is kind of the difference between those two, or if you will, it's kind of the foreign official holdings of U.S. treasuries as a share of marketable treasuries. So out of all the treasuries out there outstanding, what share are held by foreign countries? And you can see that that's gone down a lot. It doesn't mean that they're selling treasuries. That's not what I'm saying. But what they've been doing instead of buying more treasuries is buying more gold. So central banks around the world are adding a lot more to gold as opposed to adding to U.S. treasuries. That provides a huge tailwind for gold to be able to do better and continue to cause demand, people buying gold, and for gold to be able to go up higher. And you can see this is foreign official treasury holdings minus gold reserves. And that's definitely gone down a lot. And that's kind of what I was pointing out up top there. All right, so shifting over to bonds. And bonds had a really good year last year. As you can see, even the aggregate, the main kind of bond index benchmark did 7.3%. Emerging market bonds, helped by a weaker dollar and strong emerging markets, actually did 11.1%. MBS is an area that we've kind of we like MBS not just right now specifically, but over time. They're a little bit similar to treasuries in that they tend to be they're a government bond, and they tend to be lower correlated to stocks. So treasuries and mortgage-backed securities, MBS, tend to go up a lot of times, historically speaking, when markets go down, especially in an environment when markets are going down and the Fed starts lowering interest rates. So as opposed to high yield bonds, which are corporate bonds, that's very much has a higher correlation to the stock market, which doesn't provide you good diversification. So if you only held US stocks and high yield corporates, then yeah, you may get a good return when everything is going up, but when everything is coming down and you go into a recession, these high yield corporates are going to fall almost at the same rate as stocks would fall. And so you have two asset classes going down at the same time. That does not provide diversification. On the other hand, MBS and treasuries will tend, especially long-term treasuries, a lot of times will go up when the market's going down. So that's something that we consider when we're building a portfolio with non-correlated assets, assets that don't go up and down at the same time. We want to focus, especially our safe side of our portfolio, which would be the bond side of the portfolio, on those bonds that tend to go up when stocks go down, providing you a cushion to when the markets take a hit, that your portfolio doesn't go down as much. But it's also very strategic because you can do what's called strategic rebalancing. So let's say, for example, stocks go down a lot, like 2008, long-term treasuries go up a lot in 2008. Then you have something you can sell that went up to buy the stocks when they go down. But again, if you're holding everything that's correlated and everything goes down in 2008, then if you're trying to find a good deal because everything's down, you don't have anything to sell that's up to buy when it's down. So that's why it's so important to have non-correlated assets. Now, to kind of looking at how we're positioned on the bond side of our portfolio, we had tips during the year. It did do a halfway. It actually had a pretty good first half of the year. Inflation was starting to pick back up. In the second half of the year, inflation started coming down. So we've actually got out of our tips right now. And like I said, we tend to hold a little bit more MBS, and we're pretty much neutral in terms of duration, meaning the same length of bonds, duration, or time frame of bonds, maturity dates, than what the benchmark has. Okay. This is a chart kind of like the one that I was showing you from a valuation perspective, but from a yield perspective, the different you can see different time frames of decades, if you will, of what markets or what the bond market did and the returns that they had when yields were lower or when higher. So what this is saying is wherever on this gray line yields are currently, then if you look at the subsequent 5-year annualized return, that's where all the blue dots fall. And so, when yields are really high, you can expect a good next 5-year period, kind of like we had back in the early 80s. But when yields are really low, like we had in the early 2020s, you can see you actually had negative returns over the next 5 years. Well, we're kind of gotten, yields have come up quite a bit, and now they're starting to fall a little bit, but we're kind of a little bit in a sweet spot here of maybe not stellar returns for bonds, but over the next 5 years, based off of this regression analysis here, that the bond market should get about a 4.33% return based off of its yield. Now, that doesn't excite a lot of people when the markets do as well as they did last year, but compared to what we were getting for bonds just 5, even 10 years ago, it's significantly better. And bonds tend to be a good holding to have, especially when you invest the way we do, that where it can be very non-correlated, and you can, so it adds some safety, it adds some income, and stabilizes your portfolio. All right, so getting towards the end of the presentation here, if we look at where we expect, or where the market expects the Fed to lower rates, or if they're going to lower rates, or where rates are expected to go, there's the market right now is expecting basically to go down 1%. Actually, the market's expecting 2 rate cuts this year. The Fed's expecting 1 rate cut this year. So the Fed, FOMC, or the Federal Open Market Committee, is the red line. The light blue line is market expectations for the federal funds rate. And you can see that they differ a little bit here, but look what happens beyond 2026. The market is expecting rates will actually come back up, whereas the Fed is expecting that markets will kind of, or that the interest rates will go down, but then they will just kind of stay flat. So we'll see who's right on that one. But I would say right now, kind of looking at this year and what rates will do, kind of the one to 2 cuts is what the market and the Fed is kind of projecting right now for the whole year. And from an economic standpoint, the GDP, the gross domestic product, has actually rebounded and strengthened quite a bit. So you can see the GDP in the last reading, which was the third quarter of 2025, has a 4.3% growth in GDP. That's pretty solid. And if you look here historically where we've been, that's one of the highest points it's been in a long period of time. There is for you nerds out there, there's something called the Fed GDP Now, which uses an algorithm to predict where the GDP will go, and it's actually predicting a 5.3% growth in GDP. So that would be one of the highest times in a very long time for stock market. So some people are also, concerned that the economy is getting weaker. Well, it doesn't appear to be the case with these GDP readings. There does appear to be quite a bit of strength. Consumption is still strong. That's the biggest driver of the U.S. GDP, and that's still maintaining its strength. And we've actually kind of shifted from net exports being a drag on the GDP to now net exports actually being a plus. And that part of that is due to some of the tariffs that were put in place. So one of the reasons why we also think the market could continue to go higher, and no one knows, and we're not stuck to that. We don't have a bias to that way, but just looking at different economic occurrences and what we think is going to happen, the average income tax refund is what we're looking at here. And then what this shaded gray line is kind of where the average income tax refund should be this year. You can see this huge jump from the most recent tax bill that came out. So that could provide a stimulus for the economy. When either A, you pay less in taxes, or B, you get a bigger refund, that's money that goes into the market, that goes into consumption. That's strong for markets, and that provides a stimulus to the markets. Also, as I pointed out, consumers are still very strong, And if you see here, household debt to GDP, so the total household of all American citizens, the debt of all, like their own debt of the population compared to the GDP as a percentage, that has been improving since the financial crisis. That puts the consumer in a stronger position. Um, Now, the downside is from a government debt to GDP perspective, you can see that's been going up. So we basically shifted the debt from the population to the government. However, that peaked kind of right after COVID and has actually started to come down a little bit, providing a very small glimmer of hope, but not holding my breath on that one. So if inflation, something to monitor closely, still above the Fed's target of 2%. However, it's also come down a little bit recently, which has eased some concerns of rates having to go back up because of inflation. So to sum it all up, gold has been doing really well. We still see some tailwinds there. There's certainly some risk because any price of any asset, when it goes up as much as it has, it adds risk to that. And very important to be diversified outside of just U.S. large cap growth. For so many years, people did really well by holding the S&P 500 and even large cap growth stocks. And I'm not saying they're not going to continue to have good returns, but it's certainly become a bigger risk with where valuations are. And we've seen that international stocks and U.S. value and even U.S. mid cap or small and mid cap have started to outperform recently. So it is a good time frame, and 2025 was evidence of that, to be diversified again and not just hold the S&P 500. Like I said earlier, bonds should provide a decent return and add some stability to the portfolio. And even though the economy is rebounding, and we are seeing that, there is some caution warranted because sentiment is a bit frothy. So I just want to reiterate, we encourage everyone to maintain a long-term mindset, a well-diversified strategy, one that has a mix of non-correlated assets where everything doesn't go up and down at the same time and prioritizes discipline. That type of portfolio is usually key to enduring long-term success. So if you have any questions about your own portfolio that we're managing for you, feel free to reach out to your advisor. Also, if you have any questions about portfolios that we don't manage that you're concerned about, we'd love to talk to you about that as well. And before I hand it over to Paul, I'm going to do something I don't normally do, but I'm going to put in a plug, something that we're really excited about. And it doesn't apply to everyone, but it is something that for a few people or a percentage of the population is a very attractive offering that we have just recently built in 2025. And so AllGen, for the first time, has found a way to apply its investment philosophy to a direct indexing approach for our clients. Direct indexing is basically holding the index itself, meaning not just the ETF, where you're only holding one investment that holds all the stocks, but you're actually directly holding all the stocks. What that allows us to do is to be able to do a lot of tax loss harvesting, way more than we could do in a normal portfolio. We already do that in our portfolio and do a pretty good job at it. This allows us to do that kind of like on steroids. It can do it a lot more. So the bottom line is, and I'm just putting in a plug because we're going to put out a video that really explains in depth what direct indexing is. But for people who are expecting large capital gains in the future from selling a business, from selling real estate, or any type of maybe even selling a stock that they've had a long time, this could be a strategy that could really help you, because you could get a very similar returns and investment management that AllGen already provides, but it could also produce a lot of realized losses. That means your account can still go up, but for tax purposes, you can realize losses to be able to match up against some capital gains. And as you can see in this Vanguard study here at the bottom, a $1 million portfolio over a 10-year period. These are different 10-year periods looking back from the year that it's at. Obviously, if you go into a really bad market, it produced $1 million portfolio, produces $800,000 in losses. For someone in a very high tax bracket that is also selling a large capital gain, you're typically paying close to 24% capital gains. If you're in California, if you're in Hawaii, even more than that, and some other states as well, that provides kind of the same benefit of having a good diversified portfolio that should have decent returns over the long run, but also providing a huge tax benefit to our clients. So I'm going to stop there. We do have a video that's going to come out about that, and feel free to ask us if you think that you're a good fit for that portfolio. We'd love to talk to you about it. All right, Paul, take it away.
Very good. Thank you, Jason. As always, a lot of information there, which is great. And hopefully, some of you find that helpful or inspiring or motivating. And what you get inspired to do obviously depends on your personal situation, which is where I want to put in a plug for what I'm in charge of at AllGen. But before I do that, I just want to remind you, I know we have several questions that came in the Q&A. Feel free again to click on that Q&A box and pop some questions in there as I give a few announcements on what's going on the financial planning side and in general. You can do that, and then we'll come back and answer those questions in a second. So very quick, some other resources if you like this stuff or know someone who might appreciate some of this nerding out, if you will. We do have a blog at our website, allgenfinancial.com, where we go into different areas of finance, where it's economy, portfolios, interest rates, taxes, etc. So we invite you to go visit that if you haven't, or direct someone there who would love to see that resource. AllGenFinancial.com/blog. We also have videos that Jason and I periodically do. As he mentioned, he's going to be putting one out on direct indexing here soon, but we try to get the content for the videos from questions that our clients ask us. So, house buying tips, etc. How much should I finance? Things of that nature. So feel free to visit that on our YouTube page as well. Okay. That being said, from a financial planning perspective, just want to give you a few important dates that are coming up. For those of you who live in Florida, the Florida prepaid enrollment is opening up February 1st to the 30th is the open enrollment period, which, as many of you know or may not know, it's a limited window when you can enroll a child. They reprice the plan during that time frame, and you can actually enroll the child. So this could be important if prepaid plan makes sense for you because you have a child here, or if you're a grandparent and you want to gift this as a child. So that's coming up here shortly. And of course, the tax filing deadlines, actually not extension deadlines, just deadlines. So I apologize for that typo. But for businesses, it's March 15th. And your personal taxes is April 15th. So for those of you who we get asked this, hey, any way I can get some tax deductions? Kind of hard to do once the year's over. For last year, if you're a small business owner, you may still have a possibility or two in establishing a retirement plan for yourself. But we're always welcome, or we always invite you to have that conversation with us, especially if it makes sense for you as we update your financial plan. As you see here, we have a picture of our financial planning offering with the different cycles that we do every quarter right now. I want to announce to our clients that you will be getting a survey from us within the next day or two. As we start off a new year, what's important to us when we do a plan is what's important to you. Okay, so we want to know what are your goals for this year if you have any. Specifically, hey, you want to travel more, you want to get rid of this debt, or you want to buy a new car, etc. All that kind of stuff is important to us because it's very relevant to your planning, and we'd love to hear from you. So please stay tuned. Look in your inbox for an email from your advisor. We'll ask you some open-ended questions in the different areas of life because financial health touches different aspects of our life. So it's physical health and all types of different aspects that are important to us as we set goals for 2026. So please be looking out for that in your inbox here shortly. We'd love for you to fill that out, and we can have your feedback and have a conversation with you. From a financial planning standpoint, we always encourage you to update your plan, especially if there's a major life change. I've spoken to a few people over the last couple of weeks where they've had a professional change. So goals change as careers change, jobs change, etc. So we invite you to come on in and or get with your financial advisor to see when is a good time to update your financial plan if you haven't done so recently. And as you know, and for those of you who don't know, if you don't have an active financial plan currently, we have a roadmap that's done through a portal, data aggregator that you can see all your information in. I have people that say, wow, this is great because in an app or online, I can see everything in one place. You can't make any transactions in it, but it allows us to help you make some decisions in life. Can I afford a bigger vacation? Do I have my estate plan? Should I do a will or a trust? Things of that nature. How do I save on taxes? So we love having those conversations. If you haven't done a plan with us, we encourage you to get one started with us as it can be a very powerful tool, especially when there's a lot of moving parts in life on a daily basis. On a more personal note, I want to also this was an honor for me to present this because it goes close to the heart here. We love what just happened. One of our dear friends and client and former employee of AllGen just came back. She was also a mentee of mine, someone I've known since she was at college at UCF. Very passionate, dedicated young lady who was of huge value to us as AllGen has grown over the years. Took a hiatus from AllGen. She went to help her family business down in South Florida and had a revelation last year that she really misses this industry and said, I want to go back to AllGen. So we're so happy to welcome her back to the AllGen family on a practical basis because she's always been part of the family. But on a day-to-day basis, we invite you to reach out to her. Many of you know her from her previous stint here. So, Catherine Valencia, welcome back, and I'm sure you'll be in touch with her. And again, we invite you to welcome her back to the family. So that being said, let's get to some of the questions that we have here. And again, feel free to keep adding questions. I see a few here. Several have popped in, and I'm going to start. Okay. This is interesting. We have one that's about 6 questions in one. So let me see how, I want to dissect this for you, Jason, so you don't seem overwhelmed. Let me start with the quick and easy ones. It says, I am not living in the US at the moment. Thank you, Patty, for connecting with us internationally. Love that. Should I be diversifying more internationally?
Well, I think I read Patty's other questions too, so I'm going to combine the two and just kind of reiterate what I'm answering. But Patty had another question, basically, kind of with U.S. trust declining globally. That kind of the lack of trust in the U.S. that we've seen recently, and even a little bit last year during the tariffs as well. I should say a little bit. It's been quite a bit. How does that affect the markets and kind of our stance in this? And I do think that is a big factor. We'll see if that, because that can ebb and flow depending on what's going on currently at the moment. There may be times where people love the U.S. or they may have the kind of the fear of missing out from really good returns, where you'll see money kind of flow back into the U.S. But certainly it has been the trend where a certain percentage of the population, or even globally, have been shifting out of the U.S., whether if it's in protest or just a lack of trust. And more reason to be diversified further than just the S&P 500 and just in U.S. bonds, which I didn't mention when I was on the bond tab, but we do own some international bonds too that are domiciled in other currencies. And that's been a good performer as well. So I 100% agree that is a factor. And that is a reason to be diversified more outside of the US than just US stocks. Now, I don't know which country you live in, but
I can
which
tell you right
currency?
now, I believe it's Mexico last time I touched base
Mexico.
with
Okay. Okay. Well, I haven't seen the currency difference recently between the two, but it depends on the country you're in, depends on the currency you're in. If your currency is strengthening against the dollar, then then investing more internationally probably makes sense. If the other is the case, and your currency is weakening against the dollar, then it makes sense to still have a pretty large percentage of your assets in U.S. stocks because you have to take that currency piece into consideration. There's a lot of countries, some of them in South America, where it definitely still makes sense to hold quite a bit of U.S. And if you just look at the global share of the GDP and you look at the direction of the U.S. economy, it still makes sense to hold a significant amount in U.S. stocks. So while there are some of those concerns, I don't want everyone to think you need to overweight international and go more international than U.S. stocks. That's not how we're positioned. But we definitely have a lot more international stocks than we used to. And so having a larger portion of that and just being well diversified with non-correlated assets in general is a wise thing to do.
Very good. Very good. Thank you, Cheryl, for welcoming Catherine back and doing a shout out there. Here's an interesting one. It's speculative, of course, but how do you expect markets to react if Supreme Court rules against Trump tariffs? Is this already priced in?
Yeah, good question. That's an interesting one. I think on a couple fronts. One, I think the administration most likely has different plan Bs and Cs in place in case that happens, that they can get them back in place. From a market standpoint, that would actually be probably a good thing. That would be stimulative. That would make things cheaper. Long-term wise, though, if that happened, we have the chance of running higher deficits because right now we're getting about 300 billion a year in tariffs. So if you took those away, that would certainly create higher deficits, which deficits have started to improve slightly recently, especially with the tariffs coming in. So it is something that we'd monitor. I'm not concerned about it from the perspective of what it would do to stock markets. I think what you have to watch there is what it could potentially do to kind of overstimulating the market in the short term, and then longer term causing inflation if that was to happen. And then what that does to the strength of the dollar if you were unable to collect that revenue as a country.
Very good. Very good. So I'm going to break this question up into a few different ones. So I guess it's an anonymous person, but saying, what are your perspectives on different sectors, of the economy? So, this is a question that came up as well, usually comes up. So real estate post-COVID or with everything that's going on out with interest rates, I know we always give a comment on that. So let's start with real estate and see what you think there, and then we'll break it up accordingly.
Yeah, real estate is probably the worst performing sector right now, and probably at least over the last 12 months has been one of the worst performing sectors. Real estate in general went on a big run. Commercial real estate has been affected, and there's a lot of potential bad loans out there with that. However, as this person pointed out, some of that has shifted into different data centers and things like that. I still would caution people on real estate. Just you have interest rates may come down a little bit more, but those are short-term interest rates that are generated or that are really monitored by the Fed. Whereas your longer-term interest rates, 10-year, 30-year, which kind of more affects mortgage rates, have not really come down that much. So still expensive. A lot of those REITs and real estate investment trusts tend to carry a lot more leverage. And there's still some bad loans out there with that. So I would caution people on real estate. Also, it's just had a huge run after COVID. And so you would expect some consolidation. That's already been the case in real estate and residential real estate. So I would be careful there. What the other question was on the electrical power and that side. I do. I was trying to, there's a lot of questions in that one, but from an electrical standpoint, I mean, I think there's a huge demand for electricity. And with AI, with even cryptocurrencies, and those cause a lot of need for electricity. Nuclear has done really well recently. Electricity in general has done really well. That's also a sector that is utilities in general are affected by interest rates. So if interest rates do start to come up or they don't go down as much, you got to be a little bit careful there. But definitely the demand is there from the standpoint of the need for power. So I think there are some opportunities there. We do own a portion of utilities and energy types of stocks in the portfolio. The other one was
Well, I'll throw one in there. As items get hot, obviously gold has been the talk of the town, but this used to be the talk of the town. What are you thinking as far as cryptocurrency is concerned?
Yeah, so cryptocurrencies are interesting. There's components of it that we love. It's an alpha driver when markets are going up. So when markets are going up and it's a kind of a risk-on environment, meaning people taking more risk, cryptocurrencies, Ethereum, Bitcoin can really go up higher at a very fast rate. When markets take a hit, and they take a massive hit. There's been like 3 times in the last 5 years where cryptocurrency has dropped over 50%. And a couple times, one time specifically, Bitcoin dropped 84%. So not too many people can weather that volatility. I'm just gonna put this little seed out there. AllGen is in the process of developing something in that area, and we are going to share that to you when the time is appropriate in future quarters that I think can get the best of both worlds, which is kind of AllGen's philosophy of managing risk while maybe still being able to take advantage of the upside of cryptocurrency. So it's something that, especially now that you can own different cryptocurrencies in an ETF, and the SEC has allowed it as of the beginning of 2024. It's something that I think that could provide some greater diversification and potentially good returns. So more to come on that, but I'll leave it at that for now.
Very good. Well, I want to be mindful of people's time. I know we've gone a little bit past. It's past 12, our dedicated hour time slot. So I know there's a one or two questions, which what I'm going to do is one is very specific to the situation with taxes. So Larry, we'll get back to you on that because there's ways that we can help mitigate some of that challenge with the CPA. But if there's any other questions, please feel free to reach out to your advisor or send us an email or give us a call. We love talking about this. Again, Jason can be on here all afternoon talking about different aspects of the economy and investing. So, to address the whole Bitcoin thing, a good plan to me as a planner is what makes sense. And a diversified portfolio, when the markets went up, Bitcoin, I think, is down 14% year over year, right now at this point. And that's not saying it's bad. It's just diversifying is necessary and paying attention to the trends. So we welcome a conversation, whether it be with your financial plan, updating your will, and we wish you an amazing 2026 and hope to hear from you soon. Take care, everybody.
All right, see you guys.
Bye bye.